Bonjour de Paris. Hello, everyone. Welcome. It is Michael here with Offshore Citizen, and today we are in beautiful Paris. So where better to film than to have a nice view of the Eiffel Tower? And we are going to discuss the subject of international tax planning for French residents. Before we dive into that, though, as you might have already guessed, you should click the subscribe button, click the notification bell. You're going to get updates from us on the new videos. It's great. We would really appreciate that. If you're interested in this topic at all, in anything to do with international tax planning, legally reducing your taxes, forming companies, opening bank accounts, residencies, citizenships, etc., then please reach out to me. You can book a call, clarity.fm/Michael Rosmer at the link below, or you can check out our websites, offshorecitizen.net and offshorecapitalist.com. Okay, let's talk about how people from France can legally reduce their tax as much as humanly possible. We're going to focus primarily on the corporate side, but the personal side works as well. So just on the personal side, as a starting point, you will note that France has a worldwide tax system. So anyone who's a resident of France is required to pay tax on their full worldwide income, and the tax rates in France are high. So it's like the top tax bracket is around 157,000 euros a year. It's 45%. On top of that, you can end up with this social contribution, which is like another 17.8%. And then for higher incomes between 250,000 euros and 500 euros, there's an additional 3% charge or 4% above there. So, and that's supposed to be until France does not have a deficit anymore. So bottom line is you can pay a lot of tax at the personal level in France, and it really makes sense as much as possible to optimize your taxes. So, of course, as with any other situation, usually the easiest way to do this is to have a foreign company, have that company earn the income at some sort of a lower tax rate, and then defer it there as long as possible. Now, we're going to get into the details of how that works from a French standpoint, because there are some nuances, as with many different countries. And of course, as usual, you need to pay attention to banking and all the other things that go along with structuring. So if you want help with that, you can reach out to us. Okay, so first of all, let's talk about France employs management and control rules, meaning that if you have a foreign company that is managed and controlled from France, then it is deemed a French resident company unless overridden by an applicable tax treaty. So right off the bat there, one of the most important things, obviously we're going to form a company abroad. We'll talk in a minute about where you might want to form a company from a French tax standpoint, but you would have to form a company abroad. Okay, great. So you get a company abroad, wonderful. Then what? So then the next part of that is to say, if you form it abroad, you still have to have management and control abroad, because otherwise they can deem it to be tax resident even if it's formed somewhere else. Okay, so number one, you need to set up a company in another country, preferably a lower tax country, as we will cover. And then you need to make sure that it's genuinely managed and controlled, or you may have issues from that standpoint. Okay, now assuming you do that, let's move on to the next part. Well, actually, before we move on to that next part, let's just touch on quickly on one little interesting thing in France, which is very unique throughout Europe. So France claims to have a territorial tax system, all right? Now, this is where we get a little bit interesting, because some of you who maybe are familiar with territorial tax systems in places like Panama, in places like Hong Kong, etc., may be used to the idea of, oh, hey, this basically means that I don't have to pay tax in the local country. And France has a really, well, first of all, their structure is pretty tough. So basically, any business allocated to France is taxable in France. Any French source income, of course, is taxable in France. So there is a little bit of wiggle room there, where potentially you could have a French company, you could have foreign income, and potentially it could not be taxable in France, which is more or less the French way of applying sort of a participation exemption. Okay, so although they have actually a participation exemption in France, it's not so amazing. There's a lot of nuances and details to it that make it not nearly as easy to take advantage of as, say, Canada, right? So we'll dive into this. Bottom line is, you may be able to make the argument, if somebody was to come in to say, hey, listen, should I have a foreign company or should I have foreign business via a French company? You could make a slight argument in France, unlike in most other parts of the world, that you should do everything through the French company. It's unlikely, but in the right circumstances, it is possible. And I think that's kind of smart of them in terms of how they've done things. So that's your kind of caveat, okay? Now, let's assume that you don't do that, or actually we could look at this from the standpoint of saying you could have a foreign company that could be deemed French tax resident, but doesn't have French source income, and therefore, again, kind of applies this sort of territoriality principle, okay? Now, again, if you have management and control in France, how does that work in terms of business in France? This is where we get into the technicalities. So France, I would say more than most countries, every country, you want to go into the details. Every country, you need to pay attention to the specifics of the tax structure, and the nuances matter a lot. But in France, more than many other places, it's really worth channeling into the details to see what's going on. Okay, so let's assume, though, that you decide to form a foreign company. Just as a reference point, French corporate taxes are some of the highest in the world. Okay, so you have a default 28% rate. For really big companies, it goes up to 31%. There are some surtaxes, which can bring you from the 28% up to a little over 30%. So bottom line is, that's just at the corporate level. Before we look at the personal level, it's definitely not a tax-friendly environment. It's I would say one of the least tax-friendly environments in Europe, which is probably saying something. So yeah, keep that in mind, that tax is not good in France. If you have the opportunity, there's a lot of reason to just leave, okay? To say, okay, great, we're out. Especially if you consider the fact that France has historically, they don't at the moment, but they have historically had a wealth tax. They have all kinds of different ways to go after wealthy people. And it hasn't necessarily been that successful for them, which is why they've gotten rid of, as an example, the wealth tax. But this is just the environment you need to know you're dealing in, on top of which you're dealing with quite a bureaucratic environment where it's difficult to do a lot of these things. So although France says, hey, they're trying to encourage the tech community, and you can hear various different stories about this, etc., in my opinion, they're not doing a good job. This is not really an amazing place to operate. Plus, of course, I'm in Paris, and it's super expensive for rent in a bunch of these areas. So having infrastructure and setup in France is pretty crazy. Okay, so let's assume then that you decide to say, all right, if I'm at least staying in France, I'm going to set up foreign companies. All right, great, you do that. Well, now the question becomes, first of all, where do you set up? And this is going to be primarily based on two sets of rules. France does have controlled foreign companies rules, and they do have a participation exemption. Now, to take advantage of the participation exemption, I think we'll probably leave for another video, but if you have questions about it, you can reach out to us. For those of you who aren't familiar, participation exemption is where you can bring dividends back tax-free. And so this is a difficult thing to do in France, okay? So not for the faint of heart, I guess you would say, or not for somebody who isn't willing to engage in some reasonable planning. Let's say that you go, okay, great, from there, I'm going to, instead of just focusing on doing this in France, I'm going to form this foreign company, and I'm going to defer, okay? Well, then we have the controlled foreign companies rules. So this gives us a lot of insights into how things go. So the definition of a controlled foreign company in France is over 50% control. So if you have a foreign partner, you could be okay, right? So you might say, okay, great, I'm going to have one of us is willing to go and move to some other place, or we're partnering with somebody in some other area, and as a result, we don't have to worry about these rules. That would go quite a ways from the French standpoint. Okay, so pretty decent. But if you're a sole owner, okay, well now you're in a little bit tougher of a situation, right? And in those situations, what you probably want to do is you probably want to look to EU countries. So basically what they do is they apply a rule whereby if it's not an EU country, then the company in question has to have paid, I believe it is 50% of the French tax rate. And note, this is not the headline tax rate. This is what the company has actually paid. However, there's an exemption for EU countries. So EU countries are exempt from France's CFC rules, and as a result, you would almost certainly want to form a company in one of the EU countries. Where would that lead you? That would lead you probably to some place like Bulgaria or Hungary or Estonia or Malta or Cyprus, something like that, right? Okay, so what you would do is you would form a company probably there. Now this is, note, not necessarily going to get you to that compelling a place, right? We're not forming in a zero tax country in these environments. And I'll talk to you in a minute about maybe another way of dealing with this problem. So you can say, all right, I can't do zero tax, but I could get down to 9 or 10%. Okay, that's reasonable. If you're talking about Estonia, then they don't tax until you have a distribution, so you can potentially defer indefinitely. You can do the same thing in Latvia. There's obviously some strategies that you can use in Malta and in Cyprus. So any of these would be kind of your most compelling places from a French tax standpoint, okay? What about beyond that? Beyond that, if you say, okay, well, these are not going to get me to exactly where I want to go, you could utilize some sort of a trust structure. Now, you'd have to, it gets tricky. France is a civil law jurisdiction, so they don't have a concept of trust, so you need to make sure that you're utilizing trusts or foundations in a way that works with French laws. And of course, you have to still work around all the anti-deferral rules, but potentially that's a way to kind of make things work in your favor, okay? Now, what would happen? Like in many cases, in most countries, the foreign company would need to genuinely be foreign tax resident. Oh, by the way, another thing that's very, very important here. France has a list of unfriendly nations, and they deny you the participation exemption on unfriendly nations. They also have some rules whereby they'll levy withholding taxes, which are crazy, 75% on things such as services, etc., if the payments are made to unfriendly nations. So very, very aggressive in terms of their approach. So you definitely want to make sure you're dealing with the right jurisdictions when you're talking about France. And of course, we still want to consider banking. We still want to consider if it's relevant to payment processing, stability, the ability to hire people and have operations there that are effectively, not going to be too expensive, et cetera, et cetera. Now, there aren't substance rules at the moment in France, but they do have some anti-avoidance rules, so you have to kind of be aware of those as well, kind of like a general anti-avoidance provision, meaning that if something is set up and it doesn't pass business purpose, doesn't have economic substance to it, then you could be in a situation where they could deny those transactions. So that's something to be aware of. And the thing that goes along with it is their transfer pricing rules can be fairly onerous. So watch that. Transfer pricing, for those of you who aren't familiar, I have a video on that. I have a video on all these subjects, controlled foreign companies, transfer pricing, etc., so you can check those out. But the transfer pricing rules are when you have a cross-border non-arm's length transaction. So if, say, you have your French company doing business with your foreign company, then you could end up in a situation where that's not so great for you. So let's kind of recap what we're talking about here. So potentially, you could say, all right, we have, let's say, for instance, a Hungarian company, right? The Hungarian company pays 9% tax. You say, okay, great. We've got 9% tax. The business is genuinely in Hungary, so you don't have to worry about that. Potentially you can defer tax there or income there for quite some period of time. There's obviously some ways you could potentially get that back through loans and through various insurance products and things like this, but it's something a little bit tricky. The participation exemption, you're really primarily going to have to look to the tax treaties there, and so that's on a country-by-country basis that you want to pay attention to, because France does not offer unilateral tax credits as a part of their legislation for tax paid abroad. So, again, worth paying attention to the consequences you might face there, although in a bunch of the French tax treaties, they have that provision anyway. So again, when it comes to France, you probably want a jurisdiction that has a tax treaty, you probably want an EU jurisdiction, and you want to be able to make sure that's all going to work in your favor from the management and control standpoint, as well as the actual, where the source of the income is. So anyway, that's kind of like a high level. I would say, bottom line, realize in most cases you're going to want to form a foreign company. If you're forming a foreign company and you or a French shareholder, meaning like a parent company, own that company, you almost certainly want to do it in the EU. I listed off some of those countries for you. If not, if you can utilize some sort of a trust or foundation structure, then possibly you could look to some other part of the world, get closer to 0% tax. Whether that's worth it or not is going to be dependent on the nature of your business, the operations, et cetera, et cetera. So anyway, I hope that helps. It gives kind of a high-level overview of what's going on in France. It's not a tax-friendly jurisdiction at all. If you've got questions, please reach out to me. Again, clarity.fm/Michael Rosmer. You can book a call, or you can check out our websites, offshorecitizen.net, offshorecapitalist.com, and definitely click the subscribe button, click the notification bell. And if you like this video, click the like button. If you've got comments, you'd like to ask questions, please do so in the comments below. Or if you have some video that you'd like us to produce, then by all means, please also put it in the comments below. I will see you guys on the next video.